company name. What is it? It's given Premier acquired 80% of equity share capital of Sanford. And what you're asked to prepare is consolidated statement of financial position. So first we'll be preparing the working note. So once this is done, okay, for consolidated position is done, financial position, then profit or loss, 2 or 3 problems we'll do, and then associate with that syllabus is done. Then again, we can start, since they have extended till 31st March, we have ample time to for revision. 31st May.
But isn't there disposals also, ma'am?
Disposal is a theory, not much of practical.
Okay,
It's
so
theory.
okay.
That's it. We are done. Okay. So we'll start with the workings, and I'll be starting the revision once again. Okay. And some of you will have to attend remedial as well. It's not like you scored less. I didn't see your participation. Okay, so for a few of you, I'll be informing the remedial classes. For them, it's mandatory. Others, optional. Okay, fine. So workings, working note 1. What is working note 1? Tell me first.
Group structure.
Group structure.
Group structure. Okay. What is the group structure here? Tell.
Ma'am,
Who's acquiring who?
80% is Premier, 20% non-current, sorry.
Okay.
NCI is 20%.
See, actually Premier is acquiring whom?
Sanford.
Sanford. Okay. So this is the relationship and 80%. When is the acquisition happening?
1st June.
So note those points here. You'll be having highlighted in your exam, ACC exam. Remember to use it. This is the acquisition date. Okay. So it's happening on 1st June 2030. Okay. What is the financial year? Now I'm going to prepare this. So this is pre and post acquisition. I'm going to consider that. Fine. So the acquisition is happening on 1st June. Okay. And your financial year ends by September, 30th September. So it starts by?
It starts by October.
1st October.
1st October, sorry.
Now tell me how many months you have. What is the pre-acquisition period and what is the pre-acquisition period?
Pre-acquisition October, November, December, Jan, Feb, March, April, May, June, 9 months.
Then also telling wrongly. 8, no? So June to September, how many months? June, July, August, September. 4 months. So 12 minus 4 will be 8 here. So this 4 months is your post-acquisition. And this for 8 months is your pre-acquisition period. Okay, this you should be aware of. Fine. So, and you must be knowing 80% is the Premier's share in it and 20% is for NCI. Okay, this is the group structure. Fine. What is the second workings?
Net assets for subsidiary.
Net assets. Who is the subsidiary? Sanford, right? Okay.
Sanford, ma'am.
Fine. So let us take the 3 columns. What are the 3 columns?
At acquisition.
At acquisition. Okay.
At report.
At reporting.
Post acquisition.
Or else post acquisition. Fine. So, did they remove 3 zeros out anywhere? They didn't mention. See here, you should be very careful. In this, they didn't remove 3 zeros out, but they removed it. Okay. So that is also a mistake. Normally, if 3 zeros are removed, means they'll mention it. They didn't mention here. You have to note it down. It is a mistake. This problem has two mistakes. One is the zeros, in case if they are removing, it should be like this. See. This is mistake number one, very important part. Okay. So what I'm going to do is I'm removing here. So dollar. Okay, all. For all, this is the same. Now, what is the first one I should take for net assets?
Share capital.
Share capital. So it's given equity shares of 1 each, 12,000 and 5,000. So,
Ma'am, so 5,000 will take, no, ma'am?
yeah, this is only for Sanford. How much is Sanford having now?
5,000.
And where will I write this 5,000 first?
At
Reporting.
Reporting date, because you are picking from your financial statement. Financial statement values are at reporting date. Then you have to see if there is any change and go accordingly. Clear? First write it here at reporting date. Okay. What is the next value which you'll take?
Equity reserve.
Other equity reserve, nil. Okay. You don't have anything. No, it's shown as nil. What happened to retained earnings?
Retained earnings we will have to take.
How much?
4,500 at reporting date.
At reporting date. Okay. Done. This and all I've taken. That's it. Now, let me go to the adjustment part. Anything else is given. See here, this problem, it's mentioned. Premier acquired 80% of equity share capital of Sanford. Very good. Then the consideration consisted of two elements. This is new, right? Normally, cash transaction we have seen. This is cash and share. Can you make out? Two elements is there for consideration. That is a share exchange of, okay, one is share exchange. How the share exchange is happening? 3 shares in Premier for every 5 shares in Sanford.
Ma'am, will it be divided by 5?
Yeah, for we'll see that. Okay. So the shares issue has not been recorded by Premier yet. So Premier didn't record it yet. At the date of acquisition, share in Premier had a market value of 5. Who is issuing here? Issuing the share. So who is buying will issue the share, right? So the person who is buying the share, parent company didn't record it in the books of accounts, and this transaction will come back later because now we are finding only net asset of Sanford. This will not have a role here. So we'll finish this. Okay. So let us go down. What are the adjustments we have? The first adjustment is at the date of acquisition, the fair value of Sanford's assets were equal to their carrying amount with the exception of its property. This had a fair value of 1.2 million below its carrying amount and had a remaining useful life of 8 years at the date of acquisition. Sanford has not incorporated this in its financial statement. Can someone tell me this, what you understood?
Ma'am, I think there's an impairment, ma'am.
1.2 million, it's...
Yes, ma'am.
Yes, there is an... Of course, yes. It is actually decrease in the value of an asset. Okay, 1.2 million. So this is not recorded in the books of accounts, it seems. This is what is told. And whose asset is that? The fair value of Sanford's asset equal to their carrying amount with exception of its property. Property alone, there is a change. While doing the revaluation, it dropped down to 1.2 million. Okay, so there is a difference in this. So what you have to do is this revaluation profit or loss, where will we show in general? Revaluation surplus. Two places it will come. No?
Okay.
OCI.
OCI and
Retained earnings.
Retained earnings, right? OCI will be appearing in your statement of profit and loss, and that will be carried forward to your revaluation surplus, which will come in your retained earning part. Right? Sometimes it will be shown separately, sometimes it will be added to retained earnings. So in this problem, since other reserve is nil, it is shown in retained earnings only. So the adjustment of this 1.2 million, what we have to do? Is this a profit or a loss? 1.2 million.
It's a loss, ma'am.
It's a loss revalued at a lower rate, right? So this what we should do. If it is a loss means deduct from what?
Deduct from the asset, no, ma'am. Or from goodwill. Goodwill.
Why goodwill?
No, I'm getting confused. No, sorry.
Okay, it should be deducted from what? Where it will appear. So what I'm telling is your increase in an asset is a revaluation surplus. All of you agree with this? Yes or no?
Yes,
Yes, ma'am.
Okay. Increase in asset is a revaluation surplus. So where will we show? In profit and loss, we will show it as other comprehensive income and we'll take it to revaluation surplus, which will obviously come in your retained earnings part or in OCI. It depends on the calculation. Okay, we'll take that. So now decrease in an asset, what will you do? What will you do? Will it affect your retained earnings or not?
it will, ma'am, because we'll have to deduct. I mean, like whatever surplus we had last year, we will deduct it, and then like it will try to nullify the.
We will, yeah, we have to remove it. We have to deduct it. If it is a loss means we have to deduct it. This is not an intra group owing. Keep it in mind. This is not intra group owing. The fair value of 1.2 million is below its carrying amount. That's what they're telling. Okay, 1.2 million should be reduced in the carrying amount and it has a remaining useful life of 8 years. So what and all we have to do? We have to reduce it. The statement is prepared and it's not accounted. So we have to reduce the value of the property. This is Sanford's. Keep this in mind. This is Sanford's. So Sanford's, any change in the revaluation should be taken to its net asset. Okay. So I'm going to take it as revaluation of property. Property, no? Yeah, property. So how much is the revaluation? It is minus 1,200. I've removed 3 zeros already. So minus 1,200. Then I would have charged depreciation for that. Yes or no? Considering that it didn't get impaired, I would have charged some depreciation also. Do you agree with this?
Yes, ma'am.
So this should be reversed. Whenever there is an adjustment coming for a property,
Sorry, ma'am,
plant,
your voice.
equipment. My voice is breaking.
Oh, it must be on my end. Sorry, ma'am.
Yeah. So depreciation should be reversed. Not the entire depreciation. For this 1,200, you would have charged some depreciation, right? So that one. When was it considered? When they noticed it? This asset, this adjustments normally when we prepare it, because it is not adjusted in the reporting period. It's in your what I say in your books of accounts. This is not adjusted, not incorporated. So where I should do the calculation, here, here, or here?
I think at post acquisition, no, ma'am.
Sure.
Because all these adjustments are coming after the financial statement has been drafted.
Okay.
That's my.
Reporting and ma'am.
See, this 1,200 revaluation of property. Okay. When let's see here, just a minute. At the date of acquisition, the fair value of Sanford's assets were equal to their carrying amount with the exception of its property. This had a fair value of 1.2 billion below its carrying amount and had a remaining. So at the date of acquisition itself, this mistake happened. Yes or no? So this 1.2 million, what we took here, will appear in both the places. Do you agree with this?
Yes, ma'am.
Okay. Now coming to the reversal, depreciation reversal, when will it happen? Yes.
End of the year.
I didn't get two answers. I'm getting. Who's the other one?
I said reporting date.
Yes. I didn't get Dun. No. Yes, Dun. Tell me clearly.
Ma'am, I was telling reporting date.
At reporting date, correct. Because this depreciation will be charged at the year end. So it will be coming at the reporting date, right? But revaluation of the property at the acquisition, it's happening. But depreciation will be charged at the year end only, which is even reporting date. So coming here, how will I compute it? So coming to the depreciation part, okay. So this depreciation I'll be charging at the year end, and they say it is, someone is unmuted. So this depreciation, how many months we have to compute? This is for 1,200 is the asset value, right? Asset impairment happened for 1,200. So this is 1,200. What is the remaining life of the asset?
8 years.
8 years.
8 years.
Okay. Into. Will I charge it for the entire year?
No, ma'am.
So how many months will I charge them? They didn't mention when this is at this particular adjustment is a bit tricky. Listen, remaining and all is easy only. This one adjustment is new and tricky. Yes. Yeah. Tell me. So at the date of acquisition, it has a useful life of 8 years. It is mentioned at the date of acquisition. So the revaluation is happening at the date of acquisition. Acquisition is happening when?
At 1st June.
1st June. So will you charge depreciation on the date of acquisition?
No, ma'am. Usually on reporting.
Actually, you should remember the non-current asset IAS 16. You should be aware for this. Fair value, how we'll be doing? I'll just give a brush up of this fair value computation. Depreciation, if your asset is revalued year end, means from that date only the depreciation for the next year only we will compute the depreciation. Here the asset is the depreciation value, it is computed on at acquisition. At the date of acquisition only we are computing, means the revision of the asset is happening at the date of acquisition. That is, let us assume 10,000 was my asset previously. I'll just take one note and explain. Just a minute, I'll share another screen. Let us finish this one adjustment. No problem, but you should understand very clearly. Okay. So I've shared the entire screen. Just listen here. So you have an asset. Let us assume the asset value is, sorry, $25,000. You have an asset, okay? And this you bought it in, let us assume on 1st January 2010. It's 25,000 and it had a useful life of 10 years, okay? So what will happen? You keep on depreciating it. And all of a sudden you revalue this asset on, let us assume 31st, no, 1st March I'll keep, okay? 1st March 2004, okay? Let us assume first how much will be the depreciation for until March. How much will be the depreciation until March? So what are the, how many years I've used here? So 1st Jan 2010 to 31st December 2010, you'll be having one asset. This asset will be there. And then 1st Jan 2001 to 31st December 2001 again. Then 1st Jan, I'll just change it to 3. Okay, it's taking too much of time. I'll take it to 3. Okay. So 1st Jan 2002 to 31st December 2002. What will be the depreciation every year if only useful life is given?
25,000 divided by 10.
2,500.
2,500 every time, right? Here 2,500, here 2,500, here 2,500. In March 1st, I'm revaluing this asset. So till March 1st, how many months I have? That is from 1st Jan 2002 to, I'm not taking 31st March, I'll take 28th Feb 2003. Sorry.
2 months.
2 months. What will be the depreciation for 2 months? All are imaginary figure. So yeah, tell me.
2,500 into 2 divided by 12.
2 divided by 12. How much it is? 1 by 6. So 1,250. 1 by 6. No. No. Tell me how much you get it. 2,500 divided by 6. 417.
416.
Okay, 417. So what is your accumulated depreciation now? Is it 7917?
Yes, ma'am.
Okay, I do have a calculator in my desk. So 7917 is the accumulated depreciation. So what is the carrying amount at that time? 25,000 minus 7917. Yes or no? Completely forgot.
Yes, ma'am.
70,080.
How much you're getting?
17,083.
17,083. Okay. But I'm doing a fair value revision and it's coming to, let us assume it's coming to 20,000. And my useful life remains the same. Remains the same means you will not take 10. That is, that time, that is on Jan 2000, it was 10 years. But I'm doing it on 2003. It's no change means what will happen? How many years already I provided depreciation? 1, 2, 3. 3 years I provided depreciation. So remaining 7 years will be there. Okay, this is done. This is gone. This is gone. So from here, I'll be having another 7 years. There is no change means another 7 years will be there. Okay, I can exactly tell 6.7 or 7 years. From here, it will be 7 years will be there.
Yes, ma'am.
Okay, it was. Can you hear me? Actually, there was a glitch in between.
Yes, ma'am.
Okay, so this is the, yeah.
Question, ma'am. So like in the exam, like for useful life, when there's a difference in the months also, should we take it very accurately, like 6.7 as you say?
See,
Very accurately.
normally I've seen the questions. I've not seen anywhere in FR level like this. No, it didn't happen, but I think I should check once again. I'll check and let you know. But from March means normally you can't take 6.7. No, I think it will be 7 years old. So if this I keep it as Jan, it will be 7 years exactly. But since it is March, you have a doubt whether it is 6.7 years or something, correct? So this I'll clarify it. Okay. So this revision is called as fair value revision. In our problem now, what they are telling, actually you should have your carrying amount is 17,083, but in the problem what they've given, it is revalued to 16,000. What happened here?
Loss.
Loss. Correct? No. It's a loss or not?
Yes, ma'am. It's a loss.
It's a loss. So actually, if it was instead of 16,000, if it was 20,000, what would I have done? What I would have done?
Revaluation.
I'll write it as fair value is 20,000. So there is a revaluation surplus of the difference. How much it is? 2,907. No, wrong. Correct? No. 917, right?
Yes, ma'am.
917. I would have shown like this. But now I will show in revaluation surplus means to say in my SOPL, I'll be having all revenue, everything, and finally I'll be having profit for the year. And then I'll be showing other comprehensive income. Right, in this I'll be showing revaluation surplus 2,917. And this revaluation surplus again in my SOFP, I'll be showing in what is that? We have a revaluation surplus, right? Here I'll be writing as revaluation gain. And this revaluation gain I'll be showing in my liabilities. Okay, sorry, equities. In equity, you'll be having retained earnings. Let us assume profit for the year is 10,000 means this retained earnings 10,000 will be added here. And then in revaluation surplus, I'll be showing 2,917. Correct? Yes or no?
Yes, ma'am.
Okay. Now what's happening? The case is different. Instead of 20,000, this is, let us assume it's valued at 16,000. So what will happen? What is your fair value treatment? So what will happen here? Completely it will change. Correct? No. Your fair value is 16,000 only.
Yes, ma'am.
So what happened? What is this 1,083 then? It is not your depreciation. Then what is this?
Loss.
Okay. Loss or impairment, what we call it? After charging depreciation also.
Impairment.
Impairment is for intangibles or for current asset and non-current asset also. What to say? It's for intangibles or for everything we'll use impairment. We'll just write loss as of now. This term I got a doubt now. I don't want to confuse you. So it's a loss. How will I treat this? Will I put revaluation loss here or I'll adjust in my profit? What will I do? This loss of 1,083.
Adjusting profit.
Exactly. You will adjust here in the profit. Actually, we'll call it as impairment. Only I could remember a little bit. I'll just check once. Okay. Impairment will be showing at 1,083 and your profit will reduce by 1,083 means 8,917 something. Okay. So this is our story now. Could you understand the story?
Yes, ma'am.
This is what happened here. What happened? 1,200, there is a loss. And for that 1,200, we are deducting from the retained earnings. And we are showing in the acquisition time itself because it valued. But depreciation, will you value at the time of acquisition? Will you do it for this 1,200 or later on? That is, in our case, I told no, it is 16,000 and the remaining useful life is 7 years. From March onwards, I will start valuing. At the time of, on March, there won't be any depreciation. Yes or no? At the time of acquisition, will you have depreciation here?
No. No, ma'am.
No, will not have. So post March only, the valuation will happen. Sorry, post June only, the depreciation will be charged. So from June to September, we have 4 months. So we'll be taking 4 by 12. Okay, September is your year end. So 1,200 divided by 8 into 4 by 12. How much you're getting? 1,000 into 4 by 8, 1 by 2,
50,
500.
ma'am.
50. Correct? No, 50. So that 50, it is a depreciation, but it is reversal. So I'll write here. Could you understand? Could you understand this? If you cannot,
ma'am.
means you can tell me. So this is 50 and this 50 arise after post acquisition only. Okay. Now
Yes, ma'am.
these are the this adjustment is very, very important. With this, I'll stop today's class. The remaining will do it, but this is the last problem which I'm going to do as of now. Only at the revision time, I'll be doing it.